Good morning and welcome to the World First Weekly Report. Well, tensions in the Middle East and Africa are playing havoc with equity markets. Since December we've seen the S&P 500 rally close to 12%. However, since we've seen oil go to above $100 a barrel, we've seen equity markets take a bit of a battering. The significance of oil prices was highlighted on Tuesday night. We saw a strong manufacturing index piece of data come out from the US, the ISM manufacturing data, that came out at 61.4. That was much better than expected. However, due to spiking oil prices, we saw the equity markets come off close to 1.6%. However, with the Aussie dollar remaining rather resilient, we've seen the $1 sustained for most of this week. The oil price data is also playing havoc with gold prices and Bernanke. Gold prices have gone up to above $1,400 an ounce, and this is really off the back of people using gold as a hedge against inflationary pressures. Off the back of that, we've got Bernanke, who is the key participant performing CPR on the US economy. He is undermined by the spiking oil prices. This is obviously from Americans spending more at the Bowser and less at the cash register. Bernanke attended a Senate committee this week. He noted that the pressure on inflation from the oil prices wasn't going to be as acute as first thought. Bernanke noted that, well, he allayed fears by saying that the commodity prices spike would be temporary and relatively modest increase in US consumer price inflation. In Australia, we've had a raft of data out over the last week, and it was a bit of a mixed bag. Starting off with company earnings, that was significantly down on expectations at negative 2.8%. However, there was a raft of good data as well. We had new home sales, retail sales, AIG Performance of Manufacturing Index, and GDP. They all performed well, and this is putting upward pressure on the Aussie dollar. The RBA left rates on hold this week at 4.75%, and the rhetoric from the RBA after this decision was rather dovish. The RBA Governor Glenn Stevens noted that the interest rates were mildly restrictive and remained appropriate. Therefore, we may not see a rate hike until the third or fourth quarter this year. If you'd like an update on the market or if you'd like to book a trade, don't hesitate to get in touch. Enjoy your day.